Hi, I'm Rick DeLuca with the DeLuca Real Estate Group, and I'm here today with...
Chris Busse with Apex Home Mortgage.
And as always, we're talking about lending today.
Yes.
And the thing is, we're looking at things that are great for buyers, for sellers, and investors as well. So today we're going to be talking about a word that's very big. Buzzword inside the investor world, creative financing. And a lot of people think of it as just this one thing I found. But really, creative financing is pretty much anything other than just regular,
Conventional loans.
So what can it be? Well, we see things as subject to, like subject to loans, financing. And that seems to be the big thing that a lot of investors, and there's some good things for it, also some negatives. But of course, like anything for investing on that side, there's always difficulties because it's different, it's new, the market's not used to it.
It's creative.
It's creative, yeah. So a lot of people think like, I don't know, it's different. I really don't like it. And subject to financing, a lot of times, what it is the loan stays in place.
The seller's loan.
The seller's loan, but we have a new buyer.
Yes.
And that loan stays in the seller's name. But there is a new owner on that property.
Yes.
So it can get a little bit convoluted, and sometimes people don't understand, and so they just kind of shut it down. They're negative on it. So we're discussing that, and what because in history, at one point, conventional loans used to be assumable, right?
I believe they might have been a long time ago.
Yeah.
But they are not any longer.
That changed over time, and so they haven't been that way in a very long time. And the issue is, obviously, is people have really great interest rates from the last few years, and obviously interest rates are higher today. And would it be nice to be able to sell your house, get more money, get that equity, but pass on the benefit of that great low interest rate to the new owner?
Yeah, who wouldn't want that?
But obviously, conventional loans aren't assumable. So what can we do, Chris? Are loans assumable or not?
Some loans are assumable. FHA loans, VA loans, USDA loans. Those are all assumable loans. USDA we don't really do of any here.
We don't see too
Phoenix
many.
metro market. But FHA and VA, we've done a lot of those over the last 3, 4, 5 years. And a lot of people have very low interest rates on those loans that they have. And that's part of the reason why a lot of people don't want to move today is because they don't want to give that loan up. But sometimes people do have to sell. It happens. And for whatever reason, they're moving out of town. They have to move to a bigger house. They might have an FHA loan with, say, a 3.5% interest rate on it. And that loan can be assumed by a new buyer. And again, like you were saying with wraps, with subject to loans, subject to financing, there can be pros and cons to both of these types of financing, these types of scenarios. On the assumable side, for instance, an FHA loan, if you're going to assume somebody's FHA loan, that FHA loan will have mortgage insurance on it typically. So yeah, you've got a little bit of an extra payment that you're making each month, but you're still going to most likely be saving hundreds, if not even sometimes thousands of dollars per month on an interest rate of, say, 3.5% compared to, say, 7.5% to 8%. So the benefit to the new buyer coming in is huge, absolutely huge. It's a way to get into a new home these days and have that home be affordable still. VA gets a little bit more challenging in the regard that VA loans are assumable by anybody. Any person that wants to assume a VA loan can. You do not have to be a veteran. No.
Okay.
You can be a non-veteran and assume a VA loan.
I think that's something new that nobody.
A lot of veterans don't even realize they can use their benefits multiple times. A lot of veterans don't know there's bonus eligibility. There's so many kind of misconceptions with VA loans.
Like if someone who is not eligible for a VA loan could assume that VA loan, and then that individual who had it originally most likely can even buy another property, right?
Correct.
With the VA loan.
And let's to clarify one thing. So when a buyer assumes a seller's loan, that loan, unlike the wrap or subject to, on an assumption, the loan that is in the seller's name currently is transferred into the buyer's name. So that loan is no longer in the seller's name. It's off of their credit. So
Okay.
that FHA loan is gone off of them. The VA loan is gone off of their credit. The seller can move on and do other financing as needed.
Yeah, because on the subject too, it stays in the original owner's
Seller's
name and the
name,
seller's
correct.
name, and it stays on their credit.
Correct.
Now, let me ask you this question: does it affect that the seller for the VA? Does it affect their eligibility?
It does, in the sense that if a non-veteran assumes that loan, the veteran's eligibility remains tied up in that loan. So whatever their eligibility was that was tied up in that loan originally stays there. It is not restored when that loan goes to the new non-veteran borrower.
And eligibility is
Eligibility is what the VA basically uses to determine how much
like their pot.
how much the VA will insure of the loan over and above the 80%. It's maybe not explaining it great, but basically the VA, all they do is they insure the loan, and they basically say if you have full eligibility, will allow you to finance up to 100% of that home's value.
Yeah, there's like a calculation.
There's a whole calculation that goes into it based on the loan limit for the county. So, for instance, if somebody has some eligibility tied up in a current VA loan, now it doesn't mean that they can't use their VA benefit again and go buy another home with a VA loan. They may just have to put more of a down payment down. So there's still options for that veteran to use their VA benefits on another home purchase in the future, through what's called bonus eligibility. So that's the only kind of downside. And but if you're able to have essentially like a commodity of this lower interest rate and be able to sell your home for a lot easier because of the low interest rate, you may not worry about the eligibility too much.
Okay, so let's kind of go through a scenario, because this is something I don't see a lot of people talking about. So we're talking about FHA and VA loans being assumed and getting out of the seller's name into the buyer's name. So let's walk through that process. Okay, first let's say, why would someone go this route? Well, obviously it's a benefit. I could see someone even paying a little bit more for the house.
I agree.
Because as of today, rates are 8%.
Yep.
Plus.
Yep.
So if you have like a 3.5% FHA or VA loan,
4.5-5% interest savings,
that's huge.
it's a lot of money.
Now, you have to remember that when someone did originally buy with the FHA or VA loan, they most likely didn't put a lot down.
Correct.
We see a lot of VA buyers, they finance almost up to 100% a lot of time, because that's the great benefit of it. And the FHA loan, all they have to do is put at least 3.5% down.
Yes.
So we see that depending on when they bought, they haven't paid down that loan that much. Now, we've seen it in most areas. We still have lower appreciation, but still appreciation. We haven't seen a lot of negative of depreciation really going on. So, okay, we're at the situation. Someone, let's say they were working remotely. They could work wherever they wanted. Now their company wants them back in the office, and so they have to move back to another state, purchase a home, get a rental, whatnot, and then they want to sell their house. However, they can get a little bit of extra value for this house because they got this loan. So, okay, I'm the buyer. I'm going to go buy this loan or buy this home and assume this loan. What's the process? Kind of walk us through what it looks like.
Now, the other thing that we need to talk about is the equity that's in the home, right?
Right.
When you're assuming a loan, you're assuming the loan based on the current balance of that loan. So kind of what you were alluding to there has been appreciation. Let's say you bought your home in 2019 and you had that run up of 2020, 2021, and you got a bunch of equity in there. Let's say you have a couple $100,000 in equity. You're owed that money. The new buyer has to come in with money to cover that equity.
Okay.
So there's multiple ways that can be done, though. So let's say they owe $200,000 on their FHA loan, and they're selling the house for $400,000.
Yeah.
Well, that $200,000, the new buyer either has to come in with cash to pay that, or Maybe the seller's willing to do a carryback. Again, creative
Okay.
financing here.
There we
Maybe the
go.
seller wants to act as the bank and say, I don't need my $200,000 right now, this moment. I'll leave it in the house. You can pay me, 6-7% or something, about a market rate, maybe a little under market rate if you're trying to be nice, and as a second lien on the property essentially. And you can act as the seller. You can act as the bank and be making, some interest on that on your equity. Or third is you can many times get a second mortgage to basically from another bank that's willing to lend on the home up to say 80 to 90% of the value of the home. So maybe then you only have to come in with 10 to 20% down. So the assumption play, you either are anticipating having a buyer with some cash available to put down, or they can get a second mortgage or qualify for the seller financing. So it's not going to be for necessarily every buyer out there. If somebody doesn't have any money down, unless you find one of those homes that, like you said, maybe a VA borrower bought a home with 100% financing and they haven't paid it down a whole lot. So, and you're still getting a great interest rate, but you don't have to come in with a lot of cash. There's going to be a lot of different scenarios because there's a lot of different buyers in different positions over the last 3-4 years.
Yeah. And really though, if they just bought it recently, they probably haven't paid down the loan a lot, but
No.
the plus side for the sellers, you have that appreciation.
Yeah, and
So
they would have some appreciation potentially, and we're talking if they bought maybe over a year and a half ago where rates, this could still work if you got a 5% VA loan. I mean,
yeah,
you got a 5% VA loan and you did 100% financing and you've got a bunch of a little amount of equity in the home. Why would you not, as a buyer, want to go take that loan over at 5% rather than a high 7 to 8% rate?
And I can see where, obviously, I think the difference is like this assumable style versus like a subject to.
Yeah.
A lot of times they're trying to come in with no cash, or they kind of just help the seller get on their way.
Yeah.
Whereas this, you could still have to put out some cash or go get another loan or something like that. There's that potential.
But even the subject to the wraps, I mean, you in order to do that, you need to find a seller that's willing to carry the difference if you're not wanting to come in with that.
Right.
The seller wants their equity one way or the other. So they either are carrying that second, they're carrying that, the seller carryback essentially for the remaining amount, or they are the buyer, the new buyer's coming in with the cash to cover on the wrap there. The difference with the wrap, again, the biggest difference is that loan stays in the seller's name. And it's a bit more of a,
logistical
issues that you have to deal with. A lot of times wraps were used more often in the past on distressed properties where somebody is maybe very close to foreclosure, just needs to get out, and somebody else can come in, take
not
over
necessarily
that mortgage.
in a bad condition, but a bad situation.
It's a bad situation that
It's
they just
helping
need some
out.
help, and
Yeah.
and you come in and you do a wrap, and you don't have to. You just take over the mortgage, and it's a win-win for everybody. Doing these now are turning into an interest rate play, which is just a bit different. Which I don't
So you
know
have
if
value
you've seen.
in those low interest rates.
Maybe people did these in the in the 90s, early 90s or so when rates were coming down after the 80s. I'm not quite sure. I didn't start till 2005. So, but I'm sure there's people out there that may say, oh, we did these, back in the 90s all the time when rates were so high, and now then they came down, and I guess it would have been actually the other way around because rates were high in the 80s, so nobody wants those loans. So but maybe as people were distressed though, they would come in and take over the loans. But yeah, back in the 2008, 2009, a lot of people were doing these to help people that were in kind of a distressed situation. And now people are just circling back to them and saying, hey, let's look at doing this for me to acquire your conventional loan with your low interest rate.
And they still have to qualify for that loan on their own.
On the assumability part, right.
So
assumability with the wrap,
So there's some differences. Yeah. However, I mean, when you're looking at real estate, you have these circumstances that we have right now with the high interest rate environment, And in conventional, traditional real estate, that's an issue. And then when you look at real estate investing, is actually looking for problems because, like we say, we're looking to solve problems to help people. And so this is kind of a blend of you can do both. You can help people, you can solve a problem. Every situation is different. As you can see, we're looking at all these different ways that Chris, we're trying to do some scenarios, but no two scenarios are the same ever.
No, that's why it's always good to just have conversations.
And so it's great to have a great conversation with someone like Chris who knows, someone who like us who we've worked with all these different financing. So we just you don't know exactly how it's going to work out. You just figure it out as you go.
Yeah.
Because you have to know all the different tools and then figure out which tool to use at the time.
Yeah, and one thing we didn't really talk about with the assumption piece is, so as a mortgage loan originator, I have really no involvement in either of these type of financing. This is usually just done between the buyer and the seller, the real estate agent.
Good to know.
But I'm always happy to kind of just advise, help walk through things, because the assumption process, for example, you are needing to go to the servicer, the current seller's mortgage servicer, and they have their requirements of what they want from you to make sure that you as the new buyer do qualify for that loan. So on the assumption, you're still needing to qualify debt to income, credit, all that stuff based on how that loan was originally originated and what those guidelines were in place at the time.
Now we know that a typical purchase is usually like 30 days. Mm-hmm. How do you think this is going to go?
So FHA and VA have specific timing requirements in their assumption guidelines that say the servicer, depending on if they actually originate loans or don't originate loans, but basically it typically comes down to like 30 to 45 days. I can't remember right offhand if VA might be 30, FHA might be 45 days, is the maximum amount of time that they can take to complete the assumption process. Now,
so that gets tricky though.
Out. It gets tricky though because they might send you a document, and that's from the time they receive a complete package.
Okay.
That's the key there. It might take you 3 weeks to get them a complete package.
Oh.
And so if you don't have all your ducks in a row, and that's why I'm happy to assist and help people and talk to people about this, because as an originator, I know what they're looking for, to basically be able to have a nice, clean, full package in front of them and say, hey, this is here's everything that they're going to need. Put all this together, get it wrapped up, send it to them, and you should, breeze through it then.
Okay. So not easy, but
something
different because a lot of people, they want to buy, but they can't buy. The numbers just don't pencil out for them. People want to sell, but then, maybe they're like, hey, we'll sell you this house and we'll buy your house and we'll assume each other's loans or something. There's all
That's
these
kind of a cool one.
There's all these different
little trade-off.
A little trade-off. You can kind of do a straight trade-off. You're both in the same situation, and just maybe it's just because most important thing about real estate is location, right? So maybe just location, they can find something. So there's all kinds of opportunities right now. To you could reach out to FHA people, you could reach out to VA people that have loans, and then form like a whole network. So I mean, there's all kinds of ideas that can come out of this. So we just never know where the real estate market and world is going to take us.
All we can do is kind of adjust with the changes, and that's it. We're in a very unique market here right now with these that not many of us have seen, definitely over the last 30 plus years, and so just changing, adjusting, adapting. That's all we can do, and just answer questions. Exactly. So we're talking with people about this every day. Happy to have conversations with anybody that has questions.
It's funny because a lot of people will say like, oh, I've been doing this for 30 years, 40 years. But you have to change with the times. You can't keep doing the same old thing.
Yeah,
otherwise...
every market's different. This is very different than it was in the meltdown years of 2008 and 9, 10, and which was very different than, again, the 80s and 90s. So every market's different, and all we can do is adjust and educate and learn, and so that we know what these options are that are available, so that we can bring it to you.
And we've both been through those good and bad markets, so unfortunately we see a lot of people get in when it's great because everybody's just making money and doing things, but they really don't know. They don't, right now is testing who's really good at what they do,
Yeah.
because it's difficult. It's
It
hard
is.
right now.
It is.
So look for someone who's experienced and can help you and knowledgeable and full time. And if you have any questions, just reach out to Chris or I. We're happy to help you guys.